Okay, let's unpack this. We are diving deep into the Ciena Corp earnings call, covering their fiscal fourth quarter and the full year 2025. If you were watching the market on the release date, you know this was not a typical earnings report. The stock reacted immediately, dramatically.
Oh, it was explosive. And for a very good reason. Ciena delivered results that didn't just meet the market's, bullish expectations, they completely accelerated them. It forced a major revision to the future outlook.
We saw the stock gain over 9% by the closing bell.
Right. And for you, the experienced investor, this isn't just about a quarterly beat. This validates the whole thesis that Ciena is now a central, high-leverage proxy for this massive AI infrastructure build-out.
So our mission today is clear. Move beyond the headlines and really explore the strategic nuances. We need to understand the financial levers, dissect these AI-centric wins, and really evaluate the forward guidance that convinced the market this has years left to run.
Exactly. This deep dive is all about understanding the why behind the market's conviction. This story is driven by technological scarcity, meaning just overwhelming demand, and Ciena appears to be capturing that critical bottleneck.
Let's start with the punchline then, the Q4 financials. The company reported non-GAAP EPS of 91 cents.
Which dramatically surpassed the consensus of 78 cents. I mean, that's a remarkable 16.7% beat.
And revenue was just as decisive. Came in at $1.352 billion.
Comfortably sailing past the $1.29 billion consensus. That's strong 20% growth year over year.
But what's fascinating here is how they did it. It wasn't just volume, was it?
No, not at all. It was operational execution. The quarter showed really meaningful operating leverage, which is, key for a company that's scaling this rapidly. Their adjusted gross margin reached 43.4%. That's a gain of 180 basis points year over year.
And that margin expansion, that's translating directly to the bottom line, right?
Absolutely. The adjusted operating margin hit 13.2%. That's an increase of 320 basis points over the prior year.
So they're proving they can manage costs and command pricing even while they're ramping up all these new products.
And on top of that, they finished the year in a rock-solid financial position. Generated $326 million in free cash flow just in the quarter.
And the momentum isn't just for the quarter. We saw a record full-year FY25 revenue of $4.77 billion. But the real story here seems to be in the orders.
The orders are the story. Record orders of $7.88 billion for the year, and that resulted in a massive, truly record backlog of about $5 billion entering the new fiscal year.
$5 billion. And that includes what, $3.8 billion in hardware and software alone?
That's right. And that $5 billion backlog is the linchpin of the whole investment thesis. It provides immense revenue visibility stretching out for multiple years.
Management was very careful to distinguish this from, say, the COVID-era demand, wasn't it?
They were. They explicitly stated this investment is massive and accelerating faster than anything they or the industry have ever seen. This is not some supply-demand imbalance. This is robust, durable, fundamentals-driven demand tied directly to AI monetization.
Okay, let's transition to the engine driving this acceleration, the massive AI ecosystem build-out. Management framed this as being concentrated in two major customer segments, and the insights on the cloud providers are just game-changing.
The cloud providers, the hyperscalers, they are the unquestionable star of this show. They represented 42% of Q4 revenue. And get this, they demonstrated a staggering 49% growth year over year.
49%.
But here's the critical insight for you, the investor. Management believes that these cloud providers have largely underinvested in their networking infrastructure, specifically the optical transport layer, relative to their massive investments in GPUs and compute.
So all those multi-billion-dollar GPU clusters are now bottlenecked.
Precisely. The network has become the critical long pole in the tent for operationalizing AI. If these hyperscalers can't move the massive data sets between their training clusters, or if the data can't efficiently leave the data center, those GPU investments are effectively stranded. Ciena is selling the solution to that exact bottleneck.
Which brings us directly to the strategic wins. The scale across architecture win is huge, but we should probably explain what it actually means.
Okay, so the scale across architecture is, it's essentially the glue that links these enormous AI training clusters. Think of it like this. To train the next-gen LLMs, the data center has to operate like one giant AI factory. But these facilities can be hundreds, even thousands of miles apart.
So scale across is the fabric that lets them act as one single compute platform.
Exactly. It enables training to happen seamlessly across regions.
And the competitive moat here feels incredible. They announced wins for this with 3 out of the 4 major hyperscalers. This isn't just a pilot program, it sounds like a long-term structural integration.
It creates a tremendous lock-in. Once you deploy this complex optical layer with a provider like Ciena, swapping it out is a multi-year, multi-billion-dollar headache and guarantees them revenue visibility and marketing data for the rest of the decade in this area. And they stress this is all US-centric for now. The international upside is still to come.
They also talked about a specialized solution called DCOM, Decomposed Network Management. What's its function?
DCOM is a fascinating example of co-creation, in this case with Meta. Hyperscalers need way more control and customization over their networks, so DCOM gives them that flexibility. It separates the management layer from the hardware. You can think of it as giving the hyperscaler a custom brain to run the network while still using Ciena's hardware for the heavy lifting.
And DCOM is now operational in Meta's data centers. That's a huge proof point.
It is, and they confirm they're in advanced discussions with other hyperscalers to deploy it, so it gives Ciena another critical entry point into that data center environment.
Okay, now let's look at the second major segment, service providers. Their orders were up nearly 70% for the year. That's surprising given all the focus on hyperscalers.
Well, there are two dynamics at play. First, we're finally seeing a reinvestment cycle in core transport after years of 5G buildouts and inventory digestion. But secondly, and maybe more importantly, they are benefiting massively from MOFN-managed optical fiber networks.
What exactly is MOFN?
MOFNs is basically a hyperscaler strategy. They outsource the deployment and management of vast fiber connectivity to the service providers. So if a hyperscaler needs a massive dedicated route between two cities to link those AI clusters, they contract a service provider, and that service provider, in turn, buys the gear from Ciena.
So the AI demand is pulling through the traditional service provider segment as well.
Precisely. A great example they gave was a large new MOFN project win in India with two service providers working for a major hyperscaler. It shows the AI demand is global and amplifying Ciena's reach.
This is where their technology portfolio for growing in and around the data center really stands out. We heard that this opportunity grew threefold just from FY24 to FY25.
This is a cornerstone of their strategy. They're shifting from just external networks to internal and near data center connectivity. A key part of that is their pluggables portfolio. They aim to double their FY24 pluggable revenue, and they just crushed that target, hitting over $168 million in FY25.
And they noted initial revenue from the WaveLogic 6 Nano 800 gig pluggables. For those of us who aren't network engineers, why is moving to 800 gigs so important?
It's all about density, power efficiency, and cost. When you can pack twice the capacity, 800 gigabit per second, into a tiny module that uses less power, it just fundamentally improves the economics of the data center. It allows their customers to handle exponentially more AI traffic without building entirely new facilities.
They also mentioned the Nubis acquisition, the $270 million all-cash deal. Where does Nubis fit in?
Nubis is a crucial long-term bet. It's about deepening their presence inside the data center for highly specialized optical and electrical interconnects. They're using Nubis to address the scale-up and scale-out opportunities. First products are expected in fiscal 26, but the truly massive revenue opportunity for that tech, like coherent inside the data center, that's really positioned for fiscal 27 and 28.
Which brings us squarely to the guidance. This was the most market-moving part of the call. With that $5 billion backlog, management updated the outlook. And they even said the outlook has improved since their initial guidance just a few months ago.
It's a dramatic upward revision. It just signals extreme conviction. For fiscal year 26 revenue, they updated the target to $5.7 billion to $6.1 billion. At the midpoint, that's nearly 24% annual growth. That's a huge leap from the 17% they were talking about back in September. They are running.
And they're accelerating margin goals at the same time.
Correct. The FY26 adjusted operating margin target is now 17%, plus or minus 1 point. They're telling the market they can deliver high growth and significant margin expansion simultaneously.
And for the near term, Q1 26 guidance was equally strong.
Very strong. Q1 revenue guided tightly at $1.35 to $1.43 billion, which just smashes the street consensus of around $1.25 billion. They are supply constrained. Management literally said they are sold out in Q1, and if they had more supply, they could sell more.
That supply constraint is the key context for their increased CapEx plan then. They're boosting their FY26 CapEx to between $250 and $275 million, which is way higher than their typical run rate.
This is where you connect the technical details back to investor confidence. That CapEx is funding capacity expansion to support demand out to 2027. And more specifically, a chunk of that spending is going to investing in 3-nanometer mask sets.
Why does 3-nanometer matter to an investor who doesn't follow chip manufacturing?
Well, moving to 3-nanometer signals a few things. First, it requires a massive upfront investment. That's a barrier to entry for competitors. Second, it lets them keep offering the highest performance, most power-efficient optics chips on the market. If you're building the future of AI networking, you have to be on the cutting edge of silicon. This just underscores their confidence.
On the margin front, management addressed the expected cadence improvement from the first half to the second half of FY26. Why the lag?
It's a classic new product introduction, or NPI, issue. Products like the 800 gig pluggables are just now ramping volumes. In the early stages, yields are lower, so unit costs are higher. As volumes scale and manufacturing matures, yields improve, costs come down. Plus, they're putting new pricing actions in place that will really kick in later in 26.
If we connect all this back to the broader investor context, the outperformance, over 230% in the last year, is just undeniable. The market has priced Ciena as a central AI proxy.
It has, and that's led to a divergence on valuation. On the bull side, you have analysts like Raymond James raising their target to $250, reflecting that new 21% to 29% growth outlook.
But the bears, or maybe just the more cautious analysts, are pointing to that valuation stretch.
Exactly. We saw caution from Evercore ISI. They raised their price target to $240 but kept an inline rating. Their core argument is that the current valuation might already be pricing in that aggressive earnings ramp implied by the 17% up margin target.
So the critical question for you, the long-term investor, is whether that premium is justified.
Management's conviction, backed by the data, suggests the growth is much longer than the current guidance window. You have the multi-year scale across wins locked in. You have these new multi-billion-dollar opportunities like Coherent inside the data center coming in 27 and 28. They even formally took their prior long-term guidance of 8-11% off the table, signaling this higher growth profile is the new normal.
All right, and now, as is tradition, we move to our segment. This is not financial advice. We put on our hedge fund pitch hats and discuss an outrageous yet plausible trade idea inspired by all this data.
Okay, so we've established the thesis. Ciena is at the very beginning of a multi-year fundamentals-driven surge. The near-term challenge, though, is that the stock has just seen a vertical rally, a huge, sharp move up, which has spiked implied volatility. Options are expensive right now.
So short-term momentum is stretched, and buying standard calls is just prohibitively expensive. We need a way to bet on the multi-year story without getting burned by the current high vol.
Precisely. You ignore the near-term noise, and you bet heavily on the long game, the multi-year, multi-billion-dollar architecture build-out that's just starting to hit the revenue line. So the trade pitch. Propose buying a long-dated, deep-in-the-money call option. Target a 2027 or even a 2028 expiration.
And why deep in the money?
Because it behaves much more like owning the stock. It gives you that delta exposure. But a larger portion of the premium is tied to the stock's actual price, not the temporary volatility surge. The core logic is this. You're betting that the sustained acceleration into 2027 and 28, fueled by the network expansion needed to monetize trillions in AI hardware, will just overwhelm any temporary valuation concerns. We are betting that today's price, even after this run, will look profoundly cheap 2 years from now.
A compelling, high-conviction thesis. Betting on the network, solving that long pole problem. That wraps our deep dive into the Ciena earnings call. Our key takeaways are simple. A record Q4 beat, a massive guidance raise fueled by the accelerating AI-centric network build-out, and management's unwavering confidence in multi-year margin expansion.
And my final provocative thought for you to consider. Management cited estimates that total AI infrastructure spending will exceed $7 trillion through the end of the decade. The shift we discussed, the network now being the critical long pole, is structural. So how much of that $7 trillion will ultimately be required not for the GPUs, but for the high-speed connectivity layer that Ciena dominates? That's the scale of the prize.
Indeed. And remember, any discussions on stock performance or strategy are purely for informational and entertainment purposes. This is not financial advice. Thank you for joining us.